Um, I'm going to be presenting something which is a work in progress. So I'm in the middle of working out this idea. It's not a finished product. And I welcome your comments about it. Can you hear me okay? Is the right tone of voice? Okay. My topic is evaluating the integration of liquidity norms after the crisis into surveillance of bank capital. And I want to start by giving you an overview of the three things that I would like, the three steps that I'll take in my presentation. First, I want to start with my frame for the argument, and it's a theoretical frame, and it's a quite simple frame. My point is to define financial innovation, that we ought to define financial innovation in terms of its impact on liability structure, particularly the liability structure of financial intermediaries. And I want to insist on a very robust and dynamic definition of liability structure that emphasizes concerns about the firm's funding liquidity, asset market liquidity, refinancing risk, and short-term funding. So that's my overall theoretical frame, and I'll spend the first few minutes talking about what I mean about the relevance of liability structure. And then I want to make a relatively modest assertion that bank regulators are trying to elevate the status of liquidity management in their asset liability regime for banks using proxies like short-term debt. This is a good idea. It's a very good idea. But I don't think they'll be very successful at it because of industry pushback. So that's my assertion. And I want to give you three examples from regulation of that assertion. The first example that I'm going to give you is some comments by central bank governors which suggest that they're viewing capital adequacy and liquidity as interchangeable standards, which is interesting and new for me. The second thing I want to do is I want to look at the Dodd-Frank Act and point out places in it where they've drawn heavily on the notion of liability structure in terms of diagnosing financial instability risks and correcting them. And then the third example I want to give you is a set of new requirements in Basel III that address liquidity and funding. I really think they're the best part of Basel III, and they could really make a difference in terms of reducing financial instability. So that's why they won't be implemented. But they're very good, and one of them is the liquidity coverage ratio, which requires that banks have a certain amount of liquidity to cover 30 days. And the next is something called the net stable funding ratio, which does a similar thing over a longer period, 1 year. You know, in many ways, what they do is they're telling banks, you must use hedge financing. It comes right out of Minsky. It's a mandate to hedge finance, only they've operationalized it. So let me start with the first part, the theoretical frame. Why the basis on liability structure? Well, Hyman Minsky in a 1967 essay, Financial Intermediation in the Money and Capital Markets, which I did find on the digitized archives of the Levy Institute, lays out the argument for liability structure. He starts saying capitalist is essentially a financial system. And what finance means, that's a narrower definition, is that the decision to invest is also a decision to emit particular liabilities, and that it's impossible to draw a meaningful investment demand function without simultaneously speaking in terms of the liabilities that will be emitted. So it's a narrowing of the definition of finance. Now, why should liability matter so much? Well, I think because liability structure informs the constraints of any firm. Liabilities are a firm's short run in terms of contractual obligations that have to be satisfied, and so they'll drive the firm's actions. I'm sorry, the spacing came out a little weird on this. And so again, from Minsky, he says each liability emitted by a firm carries with it an explicit contractual or contingent payment commitment. To the decision maker, the price for not meeting those commitments, the cost of default or of a forced reduction in dividends, is high. So liability structure matters because it's the sum of promises and restraints on the firm's freedom of action, and it will inform what it does on the asset side. I think another reason why liabilities matter is a traditional creditor protection notion that losses financed by debt are much more serious from a stability perspective because they weren't bargained for, whereas losses financed by equity are okay because equity's been set aside to cover what I think of as the expected unexpected losses. So that's why the debt losses are particularly problematic. So again, just to express it thematically, from capitalism, you have finance, financial firms are liability structure, in particular liabilities, and to use this common metaphor of the forest and the trees, if the forest is the financial instability hypothesis, well, the trees are particular financial intermediaries, their branches are liability structure, and the hedge, speculative, Ponzi classification, well, those are the leaves. That's the leaf level. And I want to, can I switch to the other side? Okay. Now, I'm going to use this diagram for a minute. Now, bank regulators know. Can I move away from the microphone? Yes or no? Oh, okay, then I won't. I won't. I'll stay put. The laser, and the laser is, oh, perfect. Okay, I will use the laser. Now, this is now bank regulators already know what I've told you. This is not new to them. And so that's why if you look at bank regulation, it already regulates the liability of banks very carefully. And so what I want to do now is spend just a couple of minutes on, I think of this as a liquidity regulation map of bank funding. Before the crisis, what they already had, so that you understand what's different about what they've done after the crisis. So already, and the way this is set up is this is a stylized balance sheet. Here are assets. I'm not listing any. Here are liabilities. And the shaded column is a column of bank funding. These are all different items that are used for bank funding. And then underlined are the regulations or prudential restraints that target that particular liability. And what you've seen before the crisis is that regulation tended to target a particular item on the balance sheet. So for example, demand deposits are a very important kind of funding. Reserve requirements, which are an asset side, they're an asset side restraint, are there to shore up the risk that demand deposits will run off. That's one kind of regulation. Regulators realize that funds borrowed from other banks expose both banks to more instability, and so there are regulatory limits on interbank liabilities. Regulators also realize that since banks have lost demand deposits, they've had to deal with rate-sensitive demand funds. They're having to deal with other wholesale creditors who treat them in a very critical way and will move funds away if the rate's not adequate. So there are limits on brokered deposits, which are large deposits that are moved around from bank to bank based on rate. And they've issued a lot of warnings and prudential advisories. Now, regulators have also regulated that off-balance sheet obligations matter, and so there are rules to convert off-balance sheet credit guarantees and other commitments on balance sheet, and that way to manage their funding. And then finally, I think the most important regime for managing liquidity and solvency are the regulatory capital rules that have been around for a couple of decades. Now, banks also, historically, bank regulators have made subjective assessments by examiners about the liquidity and interest mismatches on the balance sheet. But historically, it's been a subjective, qualitative analysis. And then also individual banks that are undercapitalized are subject to capital restoration plans, limits on how their assets can grow, and other kinds of increased oversight. So regulators already know this. They already know that the liability structure is where the risk is at. Can I go back to the other one? And before going on to the slide about what's changed, I just wanted to, let's see, there we go. And again, the spacing is a little strange, but I wanted to reinforce this notion that innovation means change in liability structure by looking at how some different products have resulted in liability structure problems. And the three I'm pointing out are deregulation, new products, and collateral markets. I have the bank run up here because a bank run isn't precisely a form of innovation, but its impact on liability structure is a lot like innovative products. So I put it up there as a comparator. Now, in terms of deregulation, a major example is what happened with the savings and loan crisis, in which the banks ended up having to pay more on the liability side And because of that, their balance sheets became lopsided, and they entered into risk. Another example of liability structure impact is disintermediation, in the sense that retailers were able to open other kinds transaction accounts at other kinds of firms. Banks lost demand deposits, a liability side issue, and had to turn to wholesale funders who've been much less merciful than demand depositors have been in terms of their stability. There have been a variety of new products. Securitization was a major innovation. One of the major balance sheet impacts for banks was inadvertent recourse, in the sense that a bank would securitize a bunch of loans and think it had taken them off the balance sheet, but in fact, through a variety of reasons, they would end up back on the balance sheet, sometimes under this notion of moral recourse. Similarly, I think you can look at Enron and AIG as through the lens of liability structure. With Enron, you had the problem of off-balance sheet liabilities, which ended up returning to the Enron balance sheet. And with AIG, it was the problem of contingent swap liabilities that matured and exploded the balance sheet. Now, I have Bear Stearns here, and there's a sense in which Bear Stearns involved an innovative funding practice, in the sense that they used the repo market heavily, and the repo market had transformed over the course of the bubble. So I think that's a novelty, that's an innovative thing. And their problem was that there was a run on repo. I'm sorry you can't see that. They couldn't refinance positions overnight, and so they were brought into a condition of insolvency. Okay, so what's different? So bank regulators, if they already know all this, what's different about today's moment? Well, I'm happy to say that they have learned a little bit. Regulators, they took account of the leverage and liquidity dynamics. How could they not? So they are aware of these changes, and this awareness has been expressed in the willingness to impose what I think of as holistic, bright line liquidity ratios, rather than subjective assessments to figure out whether a bank's balance sheets are sound. That's an important thing. And these also attempt to test the quality of balance sheet capital, not just the quantity of, not just the quantity of capital. That's also an improvement. And regulators are also, they've expanded the use of liability structure metrics in regulation. I'll give you an example of what I mean by that. However, I have to say, and this gets back to the point that Leonardo made, there isn't the political will to implement the best of these reforms. And again, I do think the best of these reforms are the liquidity and funding restraints that Basel has proposed. So let me start with the first. I told you I'd give you evidence of these claims. You don't have to be persuaded by my claims. I'm going to give you three kinds of evidence that I think that represent this, support this claim. First, regulators, I think, have elevated the status of liquidity by putting it on the same level as capital adequacy and solvency regulation. And my basis for that is a couple of comments. One by Fed Governor Dan Tarullo, in which he said that the Fed might be willing to relax the capital requirements for banks if they were liquid enough, if they had enough liquidity. And so in my mind, I was like, okay, well, they're trading capital adequacy for liquidity. And then sometime afterward, the Bank of England Governor, Mark Carney, made the exact converse offer, if you will. He said that banks that with adequate capital, that had a lot of capital adequacy, would be allowed to be more illiquid. They would be allowed to hold fewer low-yielding, high-liquid securities and invest in higher-yielding, low-liquid securities. And so I thought that was interesting. That was the opposite. So that's the first data point, that regulators are thinking differently about finance, and I think that's good. I think that's a good thing. Now what I want to spend a couple of minutes talking about the Dodd-Frank Act. I can criticize the United States, but I can't escape its gravitational pull in terms of its relevance for examples. And Dodd-Frank Act is quite a large act. It has 850 pages. It does many things. I just want to pick out a couple of things that, to my mind, illustrate the awareness of the relevance of liability structure. And the first is a set of different provisions that I think of as not liability externalities, but liability internalities, in the sense that what the regulation does is it specifically requires that the impact of the liability be taken into account, either in terms of establishing a price or in terms of meeting a regulatory target. So for example, the Federal Deposit Insurance Corporation has an assessment base that it uses to figure out how much a bank is going to pay for its deposit insurance. Non-deposit liabilities have been added to that assessment base, so they've been internalized into that. I think that's a good thing. Similarly, the notion of credit exposure in the Bank Holding Company Act, which governs financial relationships between affiliates, has been expanded, so there's a more expansive notion of what counts as a liability. I think that's a good thing. And off-balance sheet liabilities are going to be considered more fully for capital and systemic risk decisions. That's a set of things. Let me now make a comment. This is a comment really about shadow banking. When we talk about shadow banking, it really includes two things. It includes vehicles, like special purpose vehicles, that are used to issue credit, and also entities that are not regulated as banks. So I think the shadow banking sector has vehicles and entities. One part of the Dodd-Frank Act tries to capture non-bank entities into the regulatory net by coming up with criteria. First, to figure out what's a non-bank financial company. And then there's a series of quantitative criteria to figure out what is a non-bank financial company. And then it goes through another analysis to figure out, of these non-bank financial companies, which ones might pose systemic risk. And to figure out whether a non-bank, whether a non-bank financial company poses systemic risk, there are 11 factors. 4 of them, in one way or another, are a manifestation of liability structure. And this is language from the statute: the extent of leverage, the extent and nature of the off-balance sheet exposures, the amount and types of the liabilities, and the amount and nature of financial assets. I'm kidding here because I'm stretching here because financial assets are someone else's financial liabilities, but I think it's relevant. So that's an example of recognition that really, God is in the liabilities. It's the liabilities you have to pay attention to. Other examples of this in the Dodd-Frank Act: it limits the short-term debt of systemically relevant firms. This notion of liquidity war games, the stress testing that's required of banks by the Fed and by the banks themselves, I think of them as sort of liquidity war games. It's a good idea. We'll see what happens. And then finally, the expansion of the regulatory capital regime. A lot of good things have come out of it. One, more non-bank financial firms are going to be subject to these requirements. The statute establishes a new floor for minimum capital. Now, I understand that new floor was lower than the floor required by Brazilian regulation, so that was irrelevant in terms of a new Basel floor, but it's still important in the United States. Capital requirements have to take account of systemic risk. That's a good thing. They have to be made counter-cyclical. That's a good thing. And there's been a limitation of a certain kind of instrument. Now, I have about 8 minutes remaining, and I want to turn to my third point, which I think is the most important part of Basel, and it's the awareness of liquidity regulation and its importance. And I want to start with a very brief conceptual history of regulatory capital in the United States. And what I've tried to do is trace when major ideas were implemented through regulation in terms of banking capital. Before 1985, U.S. regulators tended to make subjective assessments about banks' capital adequacy by comparing them to peer banks. The Fed experimented with a risk-based capital system for certain large banks and then scrapped it. In 1985, regulators adopted guidelines, and these guidelines created some of the building blocks that have since become permanent features of the capital system: ratios, a hierarchy of loss-bearing instruments. Between 1988 and 1991, 2 important things happened: Basel I, and in the United States, FDICA, which dramatically strengthened the capital regime. And that institutionalized risk-based capital for all banks, not just the global banks, as had been originally thought of. It has a focus on credit risk. 1996, still part of that, there was a very important change. The rules were amended to recognize the market risk in in the bank trading book, and it was the beginning of self-assessment by banks, letting them model their own risk. That was a good idea. And it was such a good idea that it was extended in Basel II, the most important part of which is the rise of internal models. and really the delegation to large banks of their ability to regulate themselves. What's significant about Basel III is there's a leverage ratio, but again, it's the rules about liquidity and funding rules. Let me spend my last couple of minutes on them. There are two rules that have been proposed. Again, I think they're the best part of the Basel regime. The first one is something called the liquidity coverage ratio. And what the liquidity coverage ratio is, I think it's an asset side constraint. It makes sure that the bank has enough liquidity and has enough liquid assets to honor its obligations for 30 days without returning to the refinancing market. And I think of it as a liquidity tax. The second one does a similar thing for 1 year. It's more of a liability side constraint. And it's funny, the BIS, the Bank for International Settlements document that puts this out says the goal of this ratio is to shore up medium and long-term stability, but they're talking about 1 year. So, I mean, in a way, because it rolls forward, you can think that it does that. But I think it might be an example of even how short-termism has affected the gods of Basel. A little more about how the two work. I think of the liquidity coverage ratio as the Bear Stearns provision, because if Bear Stearns had enough liquid assets, it would have been able to. It wouldn't have ended up with the problems that it did. Basically, how the liquidity coverage ratio works is, first a firm has to identify its liquidity gap, which means that that's the amount by which the anticipated outflow of liquidity exceeds 75% of the liquidity inflows. So automatically, that means that there's always going to be 25% of a gap, and that gap has to be covered by holding highly liquid assets, and the regulation classifies assets. Now, the asset classification is interesting. Cash, deposits at central banks, some sovereign obligation, they qualify as liquid assets. Collateral eligible for central bank posting, that classifies as highly liquid. And this is interesting because this, I think, the assets issued by banks, investment firms, financial holding companies, insurance companies don't qualify as highly liquid assets. And that's, I think, an example of an attempt to definancialize. Thank you. It's a part of the provision that creates a disincentive for holding financial assets issued by another financial intermediary, and I think that's probably a good thing in terms of delinking. And the rule also works with asset haircuts. In other words, the compliance value of certain assets is discounted along the lines of another very good capital solvency regime called the net capital rule, which is what the U.S. Securities Commission uses for broker-dealers. Now, this gets to Leonardo's point about lobbying. The rule as proposed has been substantially diluted through industry resistance, and the banking industries responded predictably, saying, you're going to ruin our business. This is the end of credit as we know it. And an argument I hadn't heard before: there's a shortage of collateral. There's just not enough liquidity, which I thought was a very odd argument. I think that really means they don't want to pay for premium liquidity. So there's been a compromise. A wider range of assets will now qualify as liquid assets, including equities and mortgage-backed securities. Somewhat haircut. There are lower estimates of the runoff rates of funding on the liability side that would generate the need to hold liquid assets. And the requirement to comply is going to be phased in incrementally, so that it begins in 2015 in member states that have adopted the rule. The United States has not adopted it. It recently adopted a bunch of Basel III reforms. This is not one of them, and I thought that was too bad, but that was predictable. And the requirement comes in incrementally, starting at 60% in 2015 and rising to 100% only in 2019. Now, I only have a couple of minutes, so I'm going to focus briefly on the other rule. The other ratio is very interesting. I think it's very well designed. What the net stable funding calculation does is, first of all, the bank has to classify all its assets in terms of how much of the asset value couldn't be immediately monetizable into cash. I think of it, and that's an amount. I think of it as an illiquidity charge. The bank then has to sum up all of those, the sum of those illiquidity charges, and that amount is the amount that it has to be funded by what it calls stable funding. think it's a sound idea. And then the rule proposes, it classifies funding by stability, and it's discounted by the permanence of, and the runoff of the liability. So Tier 1 and Tier 2 capital and preferred, that counts 100%. Demand deposits count 90%. Unsecured funding counts 50%. And again, here's another definancialization provision. Funding from another financial institution doesn't count for anything. So that's presumed unstable. I think that's probably a good thing. Now, so this is what it looks like. The required funding over available stable funding has to be more than 100%. And I guess I'll conclude with this. Banks are illiquid by design. They're designed to be illiquid. I mean, they're designed to borrow short and lend long, such that through serial refinancing, they're exposed to rising rates and Minskian refinancing risk constantly. They're designed to be that way. And part of what these two bookend rules do is, I think they purport to change the asset liability of structure of banks by making them fund longer and lend out shorter in terms of liquidity. And that's probably a good idea, but it might change the ability of banks to transform liquidity and maturity. Well, thank you very much for your presence, and I look forward to your comments. Thank you.
Good morning, everybody. I also would like to thank the Levy Institute Mainz and the Ford Foundation for bringing me down here. I really enjoyed our conversations yesterday, and I'm looking forward to your comments today. So what I want to talk about today is what I call a legal theory of finance, which is a synthesis of a multi-year interdisciplinary research project that I've been running with financial support from the Institute for of New Economic Thinking. The core elements of this theory I will tell you in a second, but I want to start by explaining you from where we come from when lawyers talk about finance. So lawyers have, of course, been involved in financial regulation, have thought about finance. There's a whole law and economics literature. There's also a law and finance literature that came out of economics that has been very dominant over the last 10 years or so. And that's basically the literature I've been fighting with, and I'm trying to develop an alternative to. So what has happened in law schools is actually the full embrace of neoclassical economics and an attempt to show how law actually adds and supports these theories. Rainier Krugman and Ron Gilson have written a famous article in 1984 and have rewritten this paper several times over the years, once after the dot-com crash in 2002, and then again after the global financial crisis of 2008. And the sense of the paper is to say, well, of course we know that markets can't be fully efficient because we do have things like transaction costs and information costs, but let us tell economists what legal institutions make markets almost efficient. So how law contributes to the efficiency of markets by lowering information costs by certain intermediaries that fulfill functions in that sense. So that's one strand of the literature. It's all about information costs, and if only lower information costs, then these markets will approximate their efficient ideal state. The other line of literature comes from a similar background, and that's sort of law and finance. It's much more empirically grounded, but it uses a particular set of data, and this is associated with Laporta, Lopez-Iselanes, Schleifer, and Vishny, which basically says law is, I always like to say, this is the crutches also for the legal system. So investors will invest if they can be sure that they get some return on their investment in the future, and law can help do that, right? So if we have good investor protection, good shareholder protection, we can take minority stakes in the company because we can use the legal system to enforce our claims. If we have bad protection, we will have large stakes and therefore underdeveloped financial markets. So this is how they explain essentially why some countries have better developed stock markets or better credit markets, and essentially the basic assumption is the bigger the better, the more the merrier. So great, large credit markets are always better and must sort of be associated with legal constructions. I want to start from a different perspective, and you will recognize sort of the ideational foundations for that immediately. I want to start with where Leonardo was this morning, saying actually financial markets are legally constructed. Contemporary financial markets are legally constructed. Clearly we can have relational finance, and we have this, complementary to legally structured financial markets. But we have shifted actually from relational finance, where everybody knows each other and you do kinship and locally based finance, to entity-based finance, and then beyond that to market-based finance and global financial markets. And for them, the legal construction is quite essential. Every financial asset is an IOU that can be enforced in a court of law without having to think about who constructed, issued the instrument, or who the ultimate borrower was in that. So this is quite important, because we can make these instruments fungible in large-scale financial markets only if we actually tie them directly to the law. And many of the contracts that have been created to create large-scale financial markets have features that make them quite rigid and seek to shift the risk of future uncertainty and liquidity to the other side, right? So we have margin calls and collateral calls. We have tight payment schedules built into these contracts. So I cover my back, and what the other side does, well, that's their problem essentially, right? And to the extent that we have allowed these financial markets to emerge, self-regulatory is sort of then the buzzword, or outside regulatory constraints, we have actually established a private regulatory regime through contracts that seek to shift liquidity, uncertainty, risk to the other side, and yet we of course know that you can't purge these features from the system. So if you start with legally constructed financial markets, which I think are our contemporary financial markets are to a large extent, not exclusively, but to a large extent, and you pair that with our insights about fundamental uncertainty and the volatility of liquidity, then you have the perfect ingredients for an endogenous financial crash. You're putting the system on autopilot to self-destruction. Because if and when something happens, even if you just attach a low probability to it, if that event occurs, the contractual features of our financial markets will set in motion a process that leads to the self-destruction of financial markets. Everybody has to get the collateral call, the additional assets to meet the collateral calls or the margin calls. Everybody has to pay now. Early payment structures, et cetera, are built into these contracts. You don't need herd effects or animal spirits to explain that. That, of course, adds to it. So I'm not saying this doesn't exist, but I don't think it's first order importance. First order importance is the legal construction of financial markets. So this is this is what I just described. The tendency of law to lead to the self-destruction of financial markets is what I call the law of finance paradox. We need law to build these financial markets. But if we enforce our legal commitments as written ex ante, we will self-destruct, or the financial markets will self-destruct. So what do we do in these situations? What do we observe happening, or what has to be done in these situations? Well, we have to relax the full force of the law and sometimes even suspend it. And that typically happens. Right? So you have to have some kind of flexibility built in. The problem is that many of the private contracts don't have them built in, and neither do necessarily regulations have them built in, because we think, of course, moral hazard, et cetera, et cetera. But what we typically do, therefore, because we don't have it built in as a regularized process in the structures, we typically suspend the full force of the law at the core or the apex of the system while we enforce it fully on the periphery. So the tendency, when you look at when do we suspend, well, it's when Lehman crashes, or just after Lehman crashes, before IIG goes under, right? We'll still let Lehman go. But that's sort of at the moment when the core of the system is becoming destable. That's when intervention comes in, and typically we see the suspension of the law. Note that I do include the granting of additional liquidity as a suspension of the law, because it typically includes the rewriting of the rules, what a central bank will take on its balance sheet, for example, right? And these rules have been relaxed over time. Now, the Federal Reserve Act has, since the 1930s, a rather open-ended provision, which is sort of an anticipation that we don't know the future necessarily, which says that the Federal Reserve can lend against adequate collateral. And what adequate collateral is, of course, determined in the moment of crisis by the Federal Reserve. But note that they said they couldn't bail out Lehman because it didn't have adequate collateral, but they could bail out AIG 2 days later, right, under basically a similar legal structure. So you give then the central bank a lot of powers to determine who will be bailed out. The issue here, of course, is where you make the decision whether to suspend the full force of the law, you relax the binding nature of law, that's where power becomes salient. That's where we're no longer really operating strictly within a rule-bound system, but we're thinking about renegotiating the rules. And I think that ultimately leads us to what we have to do, and we came to this a couple of times yesterday already. We have to think about a political economy of finance. But I would like sort of to basically work towards this political economy of finance through the legal system, because then I think you can also identify where it happens. Let me say two more things about that. Yesterday, I think Kevin mentioned, for example, that Geithner exempted futures in foreign exchanges from the full force of the Dodd-Frank Act. We have a long tradition of doing that. So you can basically leave regulation or leave particular practices outside state regulation. What you do, you shift it towards private regulation. It's not unregulated, it's just different agents who make these regulations. It doesn't really mean that we don't come to the same problem at some point, having to suspend the full force of the law, sometimes the contractual commitments. So the predecessors to the 2012 decision was 1974, the Treasury Amendment, which exempted all futures and swaps from this CFTC oversight. And that actually essentially was the foundation to leave that market to private regulation, and sort of has taken a while to build up, but you can trace it to legal decisions. A decision not to regulate is not a decision to create a natural market. Such things do not exist, but to leave these decisions to private agents. And once these markets have been created and create their own dynamics, then the central bank takes all the assets on its balance sheet to stabilize the system. That's when we suspend the full force of the law, and I think we have to be concerned about that, because the decision to rescue some parts of the markets or some entities and not others is inherently a political decision and has massive distributional effects. Now, what conclusions we want to draw from that, I think that really has to be carefully debated, because yes, maybe we want to have a bit more democratic oversight. We came to that yesterday already as well. And on the other hand, we probably also want to have preserved this kind of flexibility of central banks, because in an inherently unstable financial system, we do need that. So again, we're in a very paradoxical, difficult situation here. So I mentioned basically already three elements of what I call the legal theory of finance. Financial markets are legally constructed. Every financial asset is an IOU. And especially if you want to arbitrage around existing regulation, then you have to be particularly careful to be still within the ambit of the law. Because other than trying to arbitrage around this rule, you want to benefit from the full force of the law. These instruments shall be enforceable in the court of law. Right? So it's not that arbitrage is just outside, totally outside the legal system. No, it's straddling the thin line between making it still legal and yet not bearing the cost of certain regulation. And that's the art, and that's where lawyers are. That's what lawyers on Wall Street do. This is what my graduates are all about in many ways. So I said financial markets are legally constructed. Second, because of uncertainty and liquidity volatility, we have the law of finance paradox, and it's paradoxical, we can't get out, but I will come to the design features that come out of that in a second. And then the third one is, because of that, we always find ourselves at some point in time in a position where somebody has to relax or even suspend the full force of the law. We do this through bailouts, we do this through the central bank, Bernanke coming out and saying, we do everything it takes to rescue these financial markets. And Draghi coming out, of course, last year in July and saying, you know, we will do everything it takes to rescue the euro. He just adds within our legal mandate. But what that is, of course, is also subject to ECB interpretation, almost nobody else's interpretation. Three elements. The fourth element was mentioned yesterday again, and I just want to give it a little bit more structure here, which is the essential hybridity of financial systems. So financial systems are never just private or state or market, as a public or private market or state. They're always and essentially hybridic. And that goes back to the notion, I think, you know, Minsky and then Perry Merling has written a lot about this as well, is that we, in the last instance, what we want to have for our assets is cash, the legal tender that central banks can issue or states issue. But of course, not all cash is equally worth either. And that's an important issue when we come to international or transnational finance. But financial systems are hierarchically, not every issuer of financial assets is equally credible. At some points during boom phases, it looks like finance is flat. Once liquidity shortages appear anywhere in the system, the hierarchical structure of the financial system is revealed because we find out pretty quickly who is viable and who's not viable. Banks know it amongst each other, right? Goldman Sachs rolls over Bear Stearns' liabilities for a while until they no longer do. And then there's only one place for Bear Stearns to go, and that's up in the hierarchy to the Fed. No further, right? And you see the same, of course, in international relations. When Ireland basically takes on all the private credit on the balance sheet, basically, or exposes it by nationalizing the private debt, it faces a sovereign debt crisis. Where can it go? To the Troika, right? Or other countries go to the IMF. You've got to go up to somebody who has bigger pockets and can give you additional liquidity. It ultimately always has to go up to a sovereign or quasi-sovereign that has unlimited resources to high-powered money. And whoever has the most unlimited resource of high-powered money sits at the apex of the system. In the global system, it's the US Federal Reserve, right? So whatever we do with the IMF, it's much more constrained, politically, institutionally much more constrained. The global reserve bank right now is the Federal Reserve, and it has exercised these powers. So these are the four elements of the theory. I'm not saying it's a fully developed theory, but these are elements I'm playing with right now, and I'm building basically a network of doctoral programs. I'm working with Oxford and Frankfurt, and I'm hoping to expand over time also to countries like Brazil or China, other places where we can use local information to explore the ramifications of this theory. Let me just figure out how much time I have. 15 minutes, very nice. Okay, so I can continue a little bit. So these are the elements I have, and now the question is, how do we apply them? What I thought I would do here is to talk a little bit about transnational finance, because I think thinking about how we structure the global financial system from the perspective of this theory is helpful. And then I want to maybe say a few words also about Europe and compare two different strategies for coming to terms with the financial crisis in the context of Europe. So when I say we have actually a legally constructed financial system, we do. We have a hierarchical system, meaning that we're trying to, typically we have to go up in the hierarchy to find additional liquidity. And when we look at then how certain financial crises have played themselves out in the past, I think we see these elements actually. We can explain what happened in the past. Maybe it's a little bit harder to predict in the future, but I hope eventually we can do this as well. So think about financial crises, how they work themselves out, where actually also the financial intermediaries get the additional liquidity when push comes to shove. So when crises come, of course, those external intermediaries will try to retract from markets where they face not the same prospects anymore, and then try to get additional liquidity at their home central bank. So in this interdependent financial market where we have global intermediaries that have a home regulator where they get liquidity from, and they can still expose the host countries to substantial risk because they help sort of increase or even produce credit bubbles in certain times, but certainly increase and expand financial markets, credit markets in the host countries, and when push comes to shove, they pull out and seek liquidity support from their home countries. Now, according to the Basel Concordat, we have a certain division of labor. If it's a subsidiary, then the subsidiary should go to the host country, which is technically the home country, and get additional liquidity support from them. But if they can't do this, then the question is sort of, does the parent company indirectly help the subsidiary? We have a so-called, or some people have pointed out to the problem of a host country dilemma in this situation, right? You have a parent company coming in, setting up a subsidiary, using, especially in the boom before the global financial crisis, wholesale lending markets, international markets, to raise funds, to push them through to the subsidiary operating in a foreign country. And when the crisis comes and international markets dry up, pull out the funding, the sudden stop syndrome, as people at the IMF would call it, and then expose these countries to the problem of a financial crash. How do we handle these situations globally? How do we handle them regionally? What is the role of some of the backstoppers or lenders of last resort in that? I think in the international market, we are by and large operating in these kind of situations that we're trying to pull out, externalize the cost to the countries where the crisis has occurred, and only if those countries pose a threat to the survival of the system does anything else help, come after that. So does a bailout or some additional liquidity come afterwards? So the US helped Mexico in the early 1990s with additional funding because the economy was too important for the US to let go. Sometimes neighboring countries are being helped. Otherwise, we basically call in the IMF that seeks to stabilize, but mostly by imposing the full cost of the crisis on these countries. So on the periphery, we actually do enforce the law quite rigorously, and we only give sort of short-term adjustment loans to get over shorter crises. At the core of the system, when the system itself is threatened, we have, of course, much more flexibility. The greatest, I think, example for this kind of flexibility that has been exercised in the global financial crisis were the central bank swap lines, right? So as Perry Merling has said very nicely at some point in time, forget the G7, watch the C5. So if we think about power in international finance, that's where it is. It's the C5, the Federal Reserve, the European Central Bank, the Swiss Central Bank, the Bank of Japan, and the Bank of England, who throw each other swap lines, actually in billions of dollars. And what I find so interesting, again, from a legal point of view, if you download the documents from the Federal Reserve, New York Federal Reserve's webpage, you find 7-page long documents, which basically says, if something really goes wrong, we'll just open swap lines. And then we work out the details later, but we will open swap lines. Now, private swap contracts are a little bit more complex. They much more, in much greater detail, allocate legal responsibilities to the different parties. But at the top of the hierarchy, at the apex of the system, we do this with a handshake, but we do this, of course, only for those central banks that are part of the core. Each of the economies that stands behind the central bank is deemed to be essential for maintaining the core of the financial systems. And then Brad Sester wrote a wonderful little piece for the Council of Foreign Relations where he asked the question, and where is my swap line? Which, of course, was the question for many emerging markets. Some did get them. Singapore got a swap line from the Federal Reserve in the global financial crisis, but at the discretion of the Federal Reserve. So this is where power becomes salient. This is my discretion to give it to you because I think you are so important for me that I will give it to you. There's no regularized structure to do this. So in the context of a financial crisis, I think we see actually hierarchy emerge, and we also see how it's being exercised. It's used flexibly at the core where we sort of find new solutions, ad hoc negotiated solutions amongst central bankers, amongst states, or amongst really major financial institutions too. They also tend to help each other out, whereas on the periphery we can enforce, and we're still sort of also maintaining the mantra that there has to be rule of law and full pacta sunt servanda in order to maintain the credibility of legal institutions. Let me maybe say one word about how one could do this differently and what paradoxes we observe in the real world, and maybe also where we can learn lessons from. So as all of us, I think, have sort of watched the Euro crisis with some kind of amazement. I mean, if there was a region in the world where we had some institutions where you thought perhaps there could be actually a collective crisis management, it would have been the European Union, particularly the Eurozone. There's no other part in the world where financial integration and the institutional support for financial integration has gone quite as far as in the Eurozone. And yet, of course, the immediate response to the financial crisis was national bailouts rather than a regional accommodation only after each country had come out and says we're going to national bailout. Our financial system was then a meeting convened by Sarkozy at the time to try to coordinate these actions. So there was a national response within the European Union despite of the regional structures. Clearly also under the structures of the European Union, the individual countries are still responsible for their financial system, and yet, of course, there was a European bank, and there were also other institutions at the European level that could have been invoked. And then, of course, I don't have to say much about Greece and how other countries have been treated in the last couple of years. What I would like to point towards, however, is something that is not as much debated in this context, which is the Vienna initiative. This is an attempt to prevent a full-blown financial crisis or meltdown in the Central and Eastern European countries in 2008 and 2009. And there, an ad hoc regime was created outside the structures of the European Union that actually helped stabilize these countries and allowed substantially more burden sharing amongst countries than what has happened inside the EU. And I find this really contradictory and paradoxical. So where you have the established institutions, they don't allow you to do this because there's just too much national horse trading going on. But an ad hoc solution was found that helped. And I just want to give you a sense of the features of this institutional framework, because maybe this is something that we can bring forward to think about crisis management in the future. So in the Vienna Initiative, basically you had a couple of banks from Western Europe that were heavily exposed to Eastern Europe. 8 banks getting together, writing a letter to the European Commission, the European Bank of Reconstruction and Development, the EBRD, in London, and the European Investment Bank. And the only institution that really responded was the EBRD. And they started calling meetings together with the Finance Ministry of Austria. Many Austrian banks were hugely implicated in Eastern Europe, and created a series of roundtables with bankers, with central bankers, with fiscal authority, as a result of which a soft agreement was made, basically, that the Western European countries that had said, we will bail out our banks, Austria did this, Germany did this, Italy did this to some extent, at least sort of offering legal support for them. And of course, the taxpayers have always said, we're only bailing out our banks. We're not bailing out our subsidiaries in Hungary or Poland or Croatia or elsewhere. In these agreements, there was basically a tacit agreement made that the authorities would look the other way if the parent banks would use some of the funds to support their subsidiaries in Eastern Europe. The basic principle was to say we will not have an uncoordinated withdrawal of capital from Eastern Europe. If we might have to scale it back, but we will do this slowly and in a coordinated fashion rather than uncoordinated. And this means that we have to stabilize these banks. Cross-border subsidization, basically, of subsidiaries in Eastern Europe by the parent banks with a tacit agreement of the authorities in these countries not to enforce the law and not to allow that. This was then embedded in certain restructuring programs. So there was basic agreement made as, first of all, we all talk to one another. Everybody has a voice, which you don't have in the hierarchical structure of unilateral extension of swap lines or others. Everybody has a voice. We will make public the results of our conversation, which means we want to stabilize in Eastern Europe. We will not let it go under, and we make a commitment to do so. And we will make sure that we don't have an uncoordinated withdrawal of credit. These were the basic principles on the basis of which then individual country programs were implemented. Then the IMF came in, and there were also some of the features, and I want to endorse all the features. What I want to point towards is that it may be feasible to think about coordinated crisis management that doesn't leave the decision in the hands of the only power wielder in the room, but allows for others at least to express their voice and be heard in these kind of arrangements. More broadly, and with that comment I want to conclude, more broadly, I think what we need in a world where we have fundamental uncertainty and liquidity volatility, we need legal systems that have safety valves. And of course, yes, I hear the moral hazard argument, but that's also inherent in uncertain systems. We always have some kind of moral hazard issue at some level. But what we need to think about is how to proceduralize or regularize safety valves, and also how to make them accessible to those on the periphery. It is not sustainable, and I think really dangerous also for the credibility both of finance and of law to enforce the law on the periphery and always bail out at the center. You create actually more moral hazard that way at the center. So one of the ways in which I'm trying to carry this project forward is to think about safety valves. Let me give you one example, and this comes ironically, of course, from German history, which is how Germany responded to, how the courts in Germany responded to hyperinflation in the 1920s. So when, of course, creditors came running faster and faster and faster to the courts to enforce their contracts, for the first couple of years, the courts said, yeah, well, if you have a contract for 1,000 Reichsmark, 1,000 Reichsmark is 1,000 Reichsmark, they pay, you have to release them. And obviously, this was not worth anything that they had negotiated earlier. So finally, in 1923, at a time when the courts were almost breaking down by the number of cases brought, the Reichsgericht, the Supreme Court in Germany, said, invoked a principle in the Civil Code to sneak back through the back door. A principle that existed in the 19th century was rejected by the codifiers of the German Civil Code, but they just brought it back in, which was the principle of clausula rebus sextantibus, which basically says we use good faith, the good faith principle in the Civil Code, to adapt the contract to current circumstances. And the principle is, if the two parties could not have possibly foreseen a fundamental change in circumstances, then we cannot enforce the contracts as written. It would be against the principle of good faith if we were to do this. So now courts come in and basically force an adaptation of contracts. And if the parties can't agree, we will do this. So this is just one example. I don't think the courts are always the best institutions because they come too late. But the notion that we actually have in the law safety valves, I think, is an important one. You can see this differently in different legal systems. I think we can collect more examples and we can think more about how to design such safety valves so that we don't let the system run against the brick wall and then basically always come back at the top of the system where we suspend the full force of the law and enforce it on the periphery. Thank you very much.
Okay, thank you very much, Katharina and José, for very insightful and informative presentations. And I'll use my privilege as moderator to begin the questions and answers, and by throwing a couple of questions very quickly. Let's just recall that the title of the session is Governance of Financial Innovations After the Crisis, right? And I think it's fair to say in that regard that something that we often read coming from the press and from some papers on this is that, well, regulation, one of the dangerous, Roberto, Signora, thank you, is that one of the problems of regulation is that, well, of re-regulating the system, is that it should never constrain financial innovation. Okay, so my first question is, well, what are the tools, the available tools from a legal perspective, from your legal perspective, for analyzing financial innovation? Because I think that behind that statement, well, regulation should not mess or should not constrain financial innovation, behind that there is some sort of a presumption that every financial innovation will behave as if was a sort of a Schumpeterian innovation, in the sense that it will increase the productivity, not exactly explained how this is going to happen, but financial innovation is always good. Well, I don't think that's the case. And this was shown very, like, in a very scary way in the last crisis. So a lot, I would say, of financial innovations, they were actually very much destructive. They didn't raise any sort of productivity. For the first question is, what are the tools available for analyzing financial innovation, in the sense that then you can start to think about governing them, and like which ones are likely to be productive, which ones are likely to be unproductive or even destructive? Second question, quick question again, which I think the question is somewhat simple, but probably the answer may not be that simple. Remember Fernando Carvalho yesterday mentioning we were discussing about fiscal shelters and especially off-balance sheet operations. And he was saying, well, those are not something that God created. They are man-made. Yes, they are man-made, and they added a whole lot to the financial gambling in place. So again, from this more legal perspective, my question is, what are the available tools for regulating them, regulating fiscal shelters and off-balance sheets, and especially their marriage? Because when they are married, then a lot of damage can come out and did come out in the crisis. So those are my questions for you, but I think we can take a couple of other questions from
Okay,
the audience.
I have
So
two
Eric,
questions for, yeah, my name is Eric Timoine from Lewis and Clark College. Two questions for José. The first one is about, what about the regulation of non-bank financial assets held by banks? So if you look at, for example, Dodd-Frank, there's Title 14, okay, that basically is trying to regulate underwriting of mortgages and saying that what you should do is always verify capacity to pay based on income and based on availability of liquidity from households, basically. So you have a regulation of the asset side of banks too, in terms of the non-bank financial assets held by them. So maybe we should expand that to not only to mortgages, but others, like consumer lending and things like that. And the other question was, you were telling us that the liquidity ratio rules was being diluted, and now we were starting to accept equity as a liquid asset. Doesn't that set up a case where the central bank will have to accept equity in its lender of last resort operations?
thank you. Kevin,
Good morning. A great panel. Thanks for putting together a panel on law and finance. This is great. My name is Kevin Gallagher from Boston University. I have an abstract question with a concrete component. I guess my abstract question is, what in international law has led to the non-governmental governance of contracts, and how can we bring the non-governmental governance of contracts into being governed by governments? And the real example that has jarred me the most has been the International Swaps and Derivatives Association, which hovered over the sovereign debt restructuring of Europe and said whenever negotiators were talking about sovereign debt restructuring, the ISDA was saying, we have in all of these credit default swap contracts the word credit event. And if you negotiate a debt restructuring that has a collective action clause, or that if we don't like the size of the haircut, then we as the International Swaps and Derivatives Association, which is an association of private firms, will collectively make a decision that this is a credit event. And if they collectively make a decision that this is a quote-unquote credit event, then it triggers all the swaps having to be paid out. And since nobody knew the size of all the credit default swaps linked to the Greek bonds, they had the leverage, political leverage power to say, you could make this tiny little, relatively tiny little debt restructuring turn into a global systemic problem because you don't know how linked and how exposed U.S. banks are and so forth. It turned out it was only $3 billion, so it didn't have a global perspective. But if there was a full-on sovereign debt restructuring with all of the Europeans, that it clearly they could have had the power to cause a global extension of the crisis. And it's a private group. So there's my abstract question with one very real and very concerning example.
thank you very much, Kevin. I think you can start the first
Sure.
run.
I want to start with Leonardo's question about what is to be done. And I think the answer is, in general, not in law, but in ideology, because it's an ideological discourse. Law is slow to act, reactive, fossilized, and it doesn't recognize financial innovation as a risk in itself. In the United States, I mean, there's an ideology of financial triumphalism in which innovation is it's viewed as a good in itself. So one strategy that's worked is tying the harms from financial innovation to other legal interests. So for example, subprime lending was a financial innovation, and one of the arguments that was sometimes successful was, well, it might not be bad in itself, but it targets communities of color, and that's bad. So you have to find some other bad to tie it to in the law. That was the first question. In terms of Eric's two questions, I want to address the second one first about whether central banks will be bound to take collateral that qualifies under the liquidity coverage rules. I don't think so, because central banks retain autonomy to determine the kind of collateral that they will accept, although the trend has been towards accepting more kinds of collateral. I wrote an article a year ago defending that, saying central banks have become, they've gone from being a lender of last resort to a market maker of last resort. It's a point that Perry Merling makes in his book, The New Lombard Street. And I think in a financialized economy, that probably makes a certain amount of sense. So I don't want to rule out the possibility that sometimes equity would be adequate collateral. Again, it's heavily discounted. It's heavily discounted. And if the discounts were good enough, that would be okay. There probably won't be. In terms of your first question about an asset side restriction, making banks do due diligence. It's funny, by law, you're having to require banks to make a creditworthiness determination. It's a funny requirement to have. Now, I think it responds to this reality, which isn't addressed in the law, which is that secondary credit markets have been delinked from primary credit markets. The underwriting happens in the origination in the primary credit market. You would think that when that product goes to trade in the secondary market, that its pricing will carry over, and that people will evaluate the secondary market value based on its cash flows but they don't. It's, I think, the beauty contest phenomena that Keynes talks about. In the secondary market, what you've had is this trading euphoria in which investors didn't care about the obligor's creditworthiness. They just asked themselves, gee, well, there's a sucker born every minute. I'll be able to sell this to somebody, and that's my pricing. So I think that's why you have that requirement. I think it makes a certain amount of sense, and I think it will help. But I think what really has happened is the market structure of credit has changed, and I don't think the Act addressed that reality. And just in terms of that final point, Kevin's point, I just want to say that there's been Larry Katabarker is a law professor at Penn State, and he's written about how how public international law has changed. It went from being a regime where you had states and treaty-based organizations to the system that Katharina and Leonardo have been talking about, where you have a multiplicity of actors, NGOs, trade groups, and it's a much more diffuse kind of governance system. So that's all. Thank you.
Thank you, Katharina.
This is on, yes. So on financial innovation, I think I agree that there is a moment of ideology, and it's an important one. But I also would argue that there are structures of regulations that make a difference. So some comparative analysis have been done in Europe, different countries being able to spot the usage of special purpose vehicles and the accounting tricks that have been used. And France was much better than Germany, for example, to rein in these practices, and this has been attributed to some of the structural features. Because actually there's a very close and yet well-monitored and governance relationship between the banks. I think Fernando talked about this yesterday as well, between the banks and the regulators. And the regulators know exactly what's going on, hands-on, and they also understand the innovations. There's a dialogue going on, and it's structured in the institutions of banking supervision. Whereas BaFin in Germany has this total separation from the accountants. So they have actually no in-house knowledge to really interpret what's happening on the ground. So I think it's really important to think about how our regulators work, especially if the system is changing all the time. And of course, innovation in a legally constructed financial system, the most important innovation is to arbitrage around rules to reduce your regulatory cost relative to others. It becomes a regulatory game. In that game, regulators have to be on top all the time. So you have to think about how to structure regulations. It's not about ex ante reducing just information cost or transaction cost and then letting innovation happen, but being on top of the innovatory process, because it is inherently a regulatory process. And we cannot anticipate all the contingencies and where these things might go, but we have to be as close as possible to rein them in. I think that's really, really important. It is man-made, and these regulatory structures too are man-made. And if we structure them to bind our hands, we can't be in the game at all. I'm going to skip the two questions that were asked to you, but let me come back to Kevin's question, which is a really important one. So I think we are at the final end of a very long process that is difficult to reverse, that happens at different levels. It happens at international law, but it also happens in an area that is obscure as conflict of law. So conflict of law are rules that say, who can determine, or how do we determine which body of law will apply to a certain set of facts, especially if we have more than one. So for contracts, everybody has underwritten the notion of contractual autonomy. The parties to a contract can choose which law applies to their contract, irrespective of whether they have any connectivity to it. So you can be here in Latin America and have a contract in principle. Brazil was always a little bit more hesitant, but most countries have embraced that notion that is governed by English law. And this has been justified with contractual autonomy. They can choose the body of law that will apply to that. So you can go and find that legal system that accommodates your contract. Now you can still have issues about regulatory supervision then in-house, but it goes even further. So mostly in conflict of law, we think that property is governed by the law in which the property is located. Real estate is sort of the easy example. Once you have movable assets, it's a bit harder. Well, under the UCC, under the Uniform Commercial Code, the issuer of a collateral can determine the place of issuance, which means that for a collateral, you can also determine which law will govern it. So if you have a more accommodating legal system, then you will determine that this is the place of issuance of that particular piece and will be governed by that law. And because it's treated, collateral is treated mostly as a property, that law will travel with that piece of property and that collateral. So that makes it ungovernable from a public point of view because it is governed by some public, but not necessarily the one that is affected by the negative implications of that. And on top of that, you have in conflict of law, increasingly the notion private autonomy. We're even debating this day whether the parties can choose the applicable antitrust law, right? So how far do we want to push that? And on the other hand, of course, we have deregulation, and as I said before, deregulation typically means a delegation of regulation to different agents. So you have ISDA. For same reasons I've looked at ISDA. ISDA has, of course, created these model contracts for derivatives. They have created regional model contracts because they know law differs in the world. And they have found law firms in these different jurisdictions that have given them opinions to say that in principle these contracts will be enforceable in the law. On top of that, and that's the most important thing, they have lobbied over 50 legislatures around the world to allow for netting of derivative contracts. That means basically that you take these claims outside the pool of bankruptcy and allow them to net so that they will not be held up in a bankruptcy proceeding. For very good reasons, because you might bring down the entire network of derivatives contracts if you didn't do that. At the same time, you're privileging this particular market over everything else. And this bankruptcy soundness of derivatives is, at least some point, people have shown this empirically, one of the reasons why these markets have grown so incredibly. Because with few other assets do you get the privilege to be told ex ante you will not be in bankruptcy. We have legally constructed that. And ISDA, of course, has gone around the world and said this is a technical matter, and we have to protect the system of derivatives contracts. But we don't protect the social systems of countries where this whole thing might implode and create certain costs. So unwinding this will be difficult. Basically, what I'm trying to say with my safety valves, we've got to get mechanisms early on in the system where those with the back against the wall can say, these legal rules no longer apply to me. And I want to have a regularized process where we actually say, we will suspend the full force of those laws too, not only at the apex of the system.
I'm sure that you would have many more questions, but unfortunately we reached the limit of the session. And